today we're going to introduce you to Yuying Gao. With 15 years of investment experience, Yuying is a founding partner and CIO with Banyan Alpha, a quantitative asset manager specializing in China equities. The company is SEC registered and was founded in 2020, seeded by an institutional investor. And the fund employs a systematic, market-neutral strategy focused on the China A-shares market and uses models to identify investment opportunities. Banyan Alpha balances machine learning, technical forecasts, and sensibility-driven fundamental models with a layer of alternative data-powered ideas. So very hot today, anything AI, ML. And Dr. Yuying Gao started her career as a quant researcher at Blackrock and then managed quant portfolios at different shops, including at Millennium, where she managed a China A market-neutral strategy. So welcome. Thanks so much for joining us today.
Thank you, Nadine. It's really my pleasure to join you today.
We'll have to meet up. We just learned that we live not so far from each other. I was really excited when I read your background and really want to dig into your thoughts on Chinese equities right now, especially since we saw, the big run up since the reopening announcement in the fall, followed by more challenging markets over the last few months. Perhaps you can talk first about your area of focus. How do you think about your opportunity set in China, first of all?
I want to start with my portfolio characteristic first, so that you know how do we achieve that. So we strive to hold a diversified industry neutral position in China. Our investment approach involve taking long and short positions in different asset classes, including equities, total return index swaps, and index futures. So to do that, as a quant, we naturally will prefer to have a high breadth investment universe and high liquidity turnovers, because we turn our strategy pretty fast in the mid-horizon space. And also we like to have a high dispersion universe. And all these three characteristics, China has it all. So you can tell China has over 5,000 stocks listed in the equity markets, and the market participant is dominated by retail investors who like to trade and actively trading for the lottery type of investment style. All these factors give the market high dispersion, which is naturally benefit for quant style of investment. What I particularly like about China in the alpha space is, so one thing is the dominance of the retail investors. So they are still over 50% of the market participants in terms of turnover in daily trading. And this is very special if you look around the globe and see most of the developed market is actually dominated by institutional investors. For example, US is the most liquid markets and where the most of the investments are happening. It is dominated by 60% for high frequency tradings and for 20% for retail and 20% for institution. On the other hand, the second liquid market in this world, China, actually are the reverse of it. China has over 60% of retail investors and 20% for institutions, and maybe another less than 20% is a high frequency. So that really gives a source of alphas because of the retail behavior bias in terms of their trading pattern. This is one of the major alpha source for my models. And the other source of the models, that will be the steady and gradual takeover of the institutional investors in this market. As you can see, because both onshore institution and offshore institution actually is only starting with a low base in terms of equity ownership and also equity turnover participation rate. So both institutional flows, onshore and offshore, are steadily and gradually going up. So that is another source of our long-term alpha source opportunities.
And I think if we could talk a little bit about that, something that you're talking about that's very interesting that people might not understand, and I'd love for you to differentiate it, is maybe explain how do retailers trade? Like, do they hold for longer periods of time? Are they trading in and out? Are they doing smaller cap? Are certain industries like, big tech versus, the quants in your world and the institutions? How would you think about differentiating how they trade, whether it's by duration or the types of things that they're trading?
Asian retail investors tend to have a lottery type of thinking when they view the stock market instead of having a relative longer horizon of views. So they tend to bet on the hot names with a potential big payout in the short term. In that sense, they like to trade the small caps. They like to trade the growth names, and they like to trade deep value reversal kind of names. So this kind of behavior bias is caused by culture and by their potential behaviors in the past, and it's hard to correct in the short term, and that really contribute to a sustainable, consistent source of alpha opportunities. And on the other hand, retail investors do not really have the knowledge or data to have a deep analyze on the fundamentals and balance sheet as institutions. So what they rely on is highly technical indicators. They follow the charts and they follow price volume and some of the shallow news or headline kind of theme-driven ideas. All of these actually triggers the retail investors have a relative short horizon of holding. In China, it's especially it's it compared it's specifically for China because China retail investor on average actually hold the stocks less than 1 month. Compared to other developed market retail investors.
And you've already answered this question probably, like why choose China A shares? Is it a liquidity or what is it about the China A shares that you find the most appealing?
So liquidity is definitely one thing as we turn our portfolio faster in the 5 to 10 days horizon. And also we like breadth and the dispersion. As you can see, we tend to hold about 400 to 700 names. So we like the dispersion of the investment universe so that we can take a long and short bet to bet on the relative premium between the stocks. And China on its own have over 5,000 stocks listed in the exchange with high turnovers. And they have a long IPO pipeline that new listings actually keeps coming into the market. So that's another new things about China or special things about China compared to the rest of the world. IPO pipelines are pretty hot right now with long queues of new listings coming to the market. And versus the rest of the world, IPOs are kind of muted this year and last year.
And what are the sizes of your positions? Are they kind of equal weighted, that 400 to 700, and they're paired long short, or is it, how do you think about weighting of the positions?
So the weighting of the positions is a scientific method. We use mathematical optimizers to construct the portfolio, and the optimizer will consume 3 kind of forecast. One is a return forecast, and risk forecast, and the market impact forecast. What I also want to highlight about China is on the risk side is industry risk is kind of I think is a driver on the contributor in China because China as a whole is more of a macro and policy heavily impacted the market, and the industry policy risk is pretty high. Think about last year's education sector and the tech sector in China. The whole sector and industry was kind of hammered and highly regulated by policy change. So I think industry risk in China is very special and need to carefully managed in this market. So the way like what we have as a diversified portfolio that we will avoid a concentrated bet in certain industry and certain positions. So with the luxury of the high breadth of the investment universe, we were able to construct a portfolio that is industry neutral and sector neutral, which is very helpful to avoid big risk factors in this market.
And for folks who may not be as well versed as you are in the China local market, a few years ago, growth overall came from infrastructure, which benefited materials, real estate, energy, other sectors. How should investors today think about that next leg of growth? I know it's been a little bit muted after the reopening, but even by our forecasts, whether it's by the end of 2024 into 2025, China will be back to a growth engine. So, when do you expect that to occur? Like, do you take that into consideration or not? And, do you think through some of those macro plays of maybe what might be more attractive in the future versus, how growth occurred in the past?
Mm-hmm. So in the last few quarters, actually, China is deep in the COVID policy tightening phase. So what really plays out in the market is value and defensive flavor, low vol type of style investment, and also reversal. But as of last year, December, when the COVID policy, zero COVID policy got lifted, the market kind of transit into the pro-growth mode. But it is much slower and gradually transition than expectation. What do you see in the first quarter from Q1? So market definitely play a round of expectation bet that growth are actually catching up or rebound. But after March, after the new leadership takes over, actually the policy implementation and new measures of policies actually coming out in a slower pace than the market. So after March, the expectation play actually kind of muted, and people realize the recover post COVID is not as fast as people expect or strong rebound. So after March, you still continue to see the value and reversal type of strategy continue to work out well in China. That because there are in short term, there are still a few factors, risk factors hanging over the market. Number one is the second wave of COVID actually is coming, is already beginning in China, with the expectation of peak happens at the end of June. And also the real estate housing market recovered really slow, and the sales has been weakened. On the other side, the local government bond, due to the slow economic activities in the past year, has some pressure or stress to pay out their continued interest. All these three risk factors actually place some pressure on the market, but I think it's all three are transit, and the market and economy will pass over it. So to the medium long term, market will back to the growth mode. In the past, one of interesting fact in the last few months are actually the AI theme. The growth stocks actually capture a lot of momentum, follow the US AI themed. Those stocks actually, you cannot classify them as a traditional growth because the growth has not reflected in their balance sheet yet. But they are more themed or concept level of growth. So that has a very good run in the past few quarters. I think in the medium term, they may ease a little bit, but continue to have upper trend of price movement. On the other hand, some of the traditional definition growth, which you can see the growth momentum in their balance sheet will start to pick up. That include the advanced manufacturing and the new energies, and also some of the AI powered these TMTs.
And so when you've described your strategy and it really has that balance between that the machine learning, right? You talked about technical forecasts and then what you call the sensibility driven fundamental model,
Mhm.
then a layer of alt data powered ideas. Maybe walk through, what are you using for fundamental models? How does that impact your portfolio versus machine learning and the technical aspects that you're doing?
Mhm. As I highlighted previously, there are the two alpha engines or the alpha opportunities I try to capture is number one is the dominant retail investors excess trading behavior, and number two is a consistent inflow from the institutions. That being said, so I have two models try to capture each of the alpha opportunities. So the AI powered machine learning model is more focused on the technical features or technical predictors, and it turns very fast. So it's actually cracking the ideas or data much more efficient and faster than the retail investors. And we have a supreme trading setups that we can capture arbitrage the retail access trading activities caused by their behavior bias. On the other hand, our fundamental model, sensibility backed fundamental model, actually was selecting the stocks that institutional investors follows the same investment philosophy. We look at different aspects of fundamentals. Overall, we have 12 category of different orthogonal ideas of fundamentals, including the sell side community opinions and also the balance sheet strengths, ranging from the macro policy as well to the flows driven ideas. So these comprehensive fundamental models will help us to make sure our positions in the portfolios will avoid the kind of the not quality names, and make sure we are holding the good strengths, good quality and low valuation and high growth of names in our portfolios.
And one of the things I like to learn from great investors is how they define risk. So, given that you may have, whether different processes or algorithms to capture different types of alpha here, how would you describe to your investors that you either define risk or how you incorporate risk management into your security selection and portfolio construction?
Mhm. Yeah, so we actually use optimization is actually a try to maximize the Sharpe ratio of the portfolio. That means given certain risk level, we maximize the expected return of the portfolio. So the mathematic optimizers consume three inputs: the return forecast, which is coming from our uh, three models combination of return forecast and also risk forecast. We employed our risk model, which defines the risk in the industry and also style risk dimensions. And also we feed the optimizer with a market impact model because we want to make sure the portfolio is liquid and less impact on the market when trading.
And how do you deal with the things? So, for example, so we invest across the world, and including locally in China, and one of the questions we always ask ourselves, especially if you're playing, you're market neutral, but we play against a benchmark, is there's those event risks like the government deciding to put more cash in the hands of consumers or easing constraints on financial institutions or whatever it may be, which it's an opportunity, but it can be a risk for your portfolio because certain things will move pretty fast upward. It can have. It's not that the rising tide lifts all boats; is that certain things will then just pop. How do you think about that from your portfolio construction perspective, or is that not a factor to think through that? Is it really about the day to day trades? And that's the other parts you can't really think about, or do you take a more macro approach on this as well to say, okay, well, if certain things, growth slows enough, the government may respond via, various mechanisms, which could increase liquidity or financial conditions, or whatever the factor is, which could then obviously have a big effect on your portfolio potentially.
Yeah, so absolutely, China has more macro risk and policy risk in this market. So diversification is a key. So that is why we think the avoid concentrated names and concentrated industry is basically the key to keep a balanced portfolio and avoid or reduce the impact of the macro policy risk. So with the 5,000 stocks listed in the universe, and we do have the luxury to construct a balanced portfolio that is industry neutral. So we play the industry leader and laggers bet in long and short position. So even though the industry as a whole may get like a high in the policy risk. So we were able to pocket the spread between the leaders and laggers. That's one thing. And the other thing is, to your point, so the macro cycle in China has been like I would say shift quickly or shorter cycles than the US. So in that sense, we do have some of the macro monitors and expect certain factors or bet actually perform well in a easing cycle, or the other set of factors may play well in a tightening cycle. That is definitely one of the interpretation how you manage your quant models in the different macro cycle.
And when you look back, you've obviously had a great career so far. Maybe share one of the lessons learned that you have for people watching that maybe earlier, or maybe your level or even more experience. But I think all of us like to hear about lessons learned so that we can learn from them as well.
We are quant, so I think the beauty of quant is the marriage of human intelligence and the machine AI, artificial intelligence. We can utilize the strengths of different intelligence, humans and machines, to make the optimal bet of investment. To achieve that, I think the biggest lesson learned is never stop the learning and embracing the new technology and the new development. So benefit from locating in the heart of Silicon Valley. So I was lucky and fortunate to have enough exposures to the development of the machine learning space, and fascinated about it. So I think one takeaway from my career is I always want to embrace the new change or new development of this space of the new technology and keep learning, even though the first try may not be successful instantly, but do not give up and try to absorb more and learn, and eventually like the innovation happen. It doesn't happen at this one day. Gradually the innovation will happen. That's the biggest lesson, and we do benefit from our hungry of new knowledge. In the past few years, we always keep alert about the new change and embracing the new development in machine learning and gradually incorporate it into our model. So our model in the past 8 or 7 years gradually grows from a pure fundamental model into a very comprehensive, diversified model with an AI powered and data driven approach.
And where did you find the people, or where is your tech? Like, are you on a AWS backbone, or how did you build out your infrastructure to do this as a firm starting out just a few years ago?
Yeah, we actually highly benefit from AWS infrastructure. And thanks to our CTO, who are a veteran of Amazon, so a lot of infrastructures and the machine learning powered are hosted on AWS.
Great. So last but not least, how can people find you, either to keep up to speed on what you're doing, your investments, or just to get in touch with you?
You can find us, submit a request on our website or send an email to our info@banyanalpha.com directly.
Well, great. Thank you so much for sharing your experience and insights with everybody. Very exciting times, especially since, like, in a good way, because valuations are down a bit. For those looking to go long, you may not be able to be market neutral, everybody. Obviously a lot to learn from you in this environment. So thank you so much.
Thank you, Nadine. Glad to talk to you.